แล้วเลือก
I think I was muted. Oh my god. I'm so sorry. Alright. Yeah, my mic was off. I'm so sorry. Alright. Guys, just tell me. I just bought a new cam. Tell me if that was a good cup or not. I want to know. No, I'm not trading. I'm just gonna do a weekly recap. Weekly recap plus some backtesting. All right, that's what we're gonna do today. All right, that should be good. I think the cam is decent, no? Or am I tripping? Alright, so let's start right here. So what we're gonna do right now is just going back with all the trades we could have caught this week, using IFVGs only, alright? Using IFVGs only plus using the framework I showed in my last YouTube video, alright? That's pretty much what this live is going to be about, then do some quick backtesting, getting ready for the week, and yeah, that's pretty much going to be it. All right, so let me just get one thing right here. Right here, boom. You guys hear the background music? You should be able to hear the background music right here, hopefully. So yeah, I'm gonna go here. So what we're gonna do is we're gonna look at the best trades you could have caught this week, 1-to-1 risk to reward, using IFVGs, using another one of my framework. So let's get right into it. So let's go here on Monday. First thing you want to do always is when the market is opening, 9:30. Let's go to 9:30. Right here, you want to look at the RTH. All right, you want to click to the bottom right of your TradingView chart. Okay, let me just see if we can. Can you guys see it? If you go to the bottom right of your TradingView chart, you can select regular trading hours. Okay, and if you select regular trading hours, it will show you a gap. It will show you a gap, which is the difference in price between yesterday's close, today's open. And when you see this gap, then there is a likelihood of seeing price going back towards that gap here before it keeps going up or dumbs down for the day. So basically what this concept is telling you, it's the Judas swing. Basically it's 9:30 opens up, drives to the upside, and then if you start seeing some exhaustion from the buyers here, then you can start selling back towards the gap, since there's a lot of orders to get filled and we're currently at a premium. That is basically what it's telling you. It's telling you that from yesterday's close, price is trading above it, so sellers should be more interested in price, right? So right here, let's see what it does. So when it starts pushing like this super strongly, you don't want to engage. You don't want to engage too fast. And then as you can see right here, it kept pushing up. So at around 10:10, 10:15, this is not a play anymore. So you can go back to electronic trading hours. So it kept pushing up. So now what we're gonna do is that we're gonna use 15-minute gaps as areas of interest where we will possibly take a scalp from there, because we know there's a lot of potential buyers, passive buyers sitting on the bid here. So let's see. Still nothing. So we formed a lot of accumulation right here. You have the 15-minute fair value gap right there. So if we tap this 15-minute fair value gap and then we enter aggressively here, it will mean that we will possibly see a scalp back to the upside. Basically what this zone is telling me, 15-minute gaps, is telling me that there's a lot of buyers right here sitting passively. So if we enter aggressively inside the zone, then, and I can locate where the sellers are by using fair value gaps on the lower time frame, and I'll just wait for them to get squeezed so I have a scalp to the upside. So here, let's see what it does. I'll go on the 1. So you see, like, you were pretty much patient the whole day until this possible scalp here. So here you tap this 15-minute gap. So when you tap this 15-minute gap, right, you want to locate where are my sellers. You want to go from 1, 2, 3, and 5 minute chart. And what you want to see is you want to see a leg like this from swing high to swing low, which only has one gap. Okay, if it has two, you know, you could play off of it for sure, but the best one would be if there's only one gap. And if there's one gap, this lower time frame, let's say 1, 2, 3, or 5 minute fair value gap, will tell you where the sellers are. And if you know where the sellers are and you just tapped an area where you know a lot of potential buyers will be ready to defend their position, if you get squeezed, if those sellers get squeezed, you have a good play. All right, so right here, looking for a leg with only one fair value gap in it. So right here, I got a scale to the 2 minute chart. There's nothing. So there is this gap right here, right? Pretty much up inside the chart. But right here on the 3 minute, it's even better. You see, when this candle is closing, we have one gap from swing high, swing low here. So if we disrespect it, right here, you can catch a nice line. So boom, right here. So this is the first trade you could have caught this week. Stop loss right below this low. Take profit at a 1-to-1 right here. So for this internal high. So this is where you would go long. So you see the sellers right here. Really what's happening here is that you cannot even close below this sell side liquidity pool in that 15-minute gap, which tells me that there's a lot of aggression from the buyers. Plus here, if we were truly bearish, we should have respected this gap to create new lows. So right here went long. And right here you hit your target. So you had some heat here, possibly an SMT here with ES at this high. But this was the first trade you could have caught for sure. So if you want to take a picture of that, that is the first trade you could have caught. Definitely for longs. Price couldn't close below the sell side. 3 minute inverse, 1-to-1 back to the upside. All right. Price is near all-time high right now. Currently, we might be in a war, depending on the response. How will you treat in the coming weeks? Will be low risk trades for, yeah. Basically what will happen is that since there's a war, there will be a lot of volume traded basically. So you want to go on micros. That's the first thing. Second thing is that at any point during the day, there could be another news which could spike the market super aggressively. So you always want to put your stop loss super fast when you enter a position. And even that, it's risky. Let's say you trade a live account, it's risky because if there's a news and there's a huge spike, you will not get filled at the market. You will not get filled at your order. You will get filled way below. So there's going to be slippage related to that. So yeah, what I'll do is I'll just make sure I'm trading micros, and I put my stop loss really fast. But the market conditions will be just more volatile in my opinion. So right here, first trade you could have got right here off of that 15-minute gap. That's on Monday, June 16th. So then let's go to the other day. If you take 1-2 scalps a day, it's pretty decent. So right here, let's go at 9:30 open. So first thing you want to do right here, you see it's 8:59. So the market is opening at 9:30. You want to go to the bottom right of your trading view chart, select regular trading hours. So then that will give you the chart of only New York session, right? And what you will find is a gap. Most likely if there was action from the overnight session. So right here we have a regular trading hour gap. That is a gap down scenario basically. What does that mean? It means that there's a lot of orders right here to get ready to get filled, and we're currently at a discount, which means that if we're at a discount, then sellers will most likely get squeezed, buyers will be interested in price. All right, so what do you want to see? You want to see lows getting swept, and you want to see bearish fair value gaps get disrespected. All right, so right here I'm waiting for this low to get swept. and create the same exact kind of confirmation. I want to see a leg right here with a swing high, swing low right here with only one fair value gap, and this fair value gap, if we're truly bearish, we should respect it to create new lows. If we're bullish, we're going to disrespect it to see it move back towards the gap. So right here, swept this low. So I'm looking for that leg with only one fair value gap. So right here on the 1 minute chart, there's two. So sellers here, sellers here. So you know, this is the moment where you need to scale to a 2, 3, or 5 minute chart to see if there's only one gap. Then right here on the 2, if I go on the 2, there's only one gap right here from swing high to swing low. What is my swing high, my swing low? My swing high is right here, my swing low would be right here. So if I have one candle that closes above this zone, which is the area where aggressive selling occurred, then I will then try to go long towards the gap. All right, which is called the gap fill, inversion gap fill, basically I call it. That is the strategy from my last video. So boom, right here you didn't quite close above it perfectly. So here you would close above it, boom, you would wait for a pullback, stop loss right here, and then try to go for a drive back up for a 1-to-1. All right, that's what you would do. So you would get filled right here, boom, 54. And yeah, right here you get out of your position. Okay, so exactly at a 1-to-1. You, of course, you could let it, you know, ride towards 50% of the gap, but usually what you see from those gaps is that basically, if you look at, let's say, the volume profile, right here there's low volume, right here there's low volume usually, which is areas where price is attracted to. So you could see a potential bounce from here, so you need to either take profit or put your stop loss to break even, because this is an area where it could definitely, you know, start pumping back down. Also, FVG Strat have backtested it. It works better or almost really good when ES and NQ doing the same thing. Yeah, absolutely. Yeah, just make sure you're viewing the market every single day with the same framework. That's just the most important thing. Even if it's, you know, RTH gaps, using inversions, or using 15-minute fair value gaps to frame who's in control of the market during the day to catch scalps. You know, do what you have to do, but do the same thing every single day. That's the most important thing. If you try to catch a 2022 model here and then, you know, an SMT market structure shift there just because it looks good, or you try to go for, you know, data highs or data lows here and there just because it looks good, it will eat your profits so much to a point where you will not even see any progress. So yeah, just keep the same framework. This gap right here, it's not a new concept, you know. It will get filled. It will get filled, especially during certain market conditions when it's not trendy. Okay, when it's not trendy, and let's say the market had a move down during London, what you will see most likely is this happening. Asian will chop, London will take out the high of Asian, form possibly the real high of day, market structure shift right here, and New York will open. And as soon as New York opens right here, what does that mean? If New York closed right here on the previous day, it means there's a gap. And if there's a gap, what will most likely happen? Buy side gets swept, market structure shift to the downside, and that would be your New York continuation, London reversal. You know, everything just is kind of the same thing if you view it, if you have the right approach. You know, everyone is trading kind of the same thing. Even if it's daily profile, weekly profile, or open, high, low, close, you're trading kind of the same thing, you know. So yeah, so why is this trade, let's say, a good trade? In my opinion, it would be because there is multiple things, like I said in the last video that I made, that makes this setup a good setup, and any setup that you can find edge in is the fact that, you know, finding the statistical edge of the RTH gap getting filled in a year-to-year basis is something that you can definitely like find true edge in. Let's say you would set a timer and you would say, okay, I'm only gonna look for trades during 9:30 to 10, let's say 10:20, for the gap fill, using inverse fair value gaps as my way of entry, and believing that in fair value gaps there is aggressive selling, aggressive buying, etc. So you're playing the squeeze and you're playing the gap fill. So if you go back to the data of, let's say, from 2018 to 2025, only from this time window, then you will know the statistic of the gap getting filled. All right, so now you will have a statistic of, let's say, 61% chance of the gap being filled. All right, this is good, let's say. And then you will also have a statistic of, let's say, the rest, so 39% of the gap not being filled. But then when you see the 39%, did we have our entry model right here? If we didn't, then you cannot, there is a percentage right here that you wouldn't have taken a loss, really. And then on the other, let's say the other percentage of chances of losing, let's say that you saw price creating an inverse towards your gap, but you lost, you have parameters that can, now you need to find the parameters that makes that trade being a loser. And if there's any, you know, if that's, let's say, something that is repeatable, that loss, is it something that you see often with your data? Okay, you need to look at parameters. Okay, so let's say the parameters right here, how big is the gap? If the gap is like, let's say 400 handles, then the price action is too strong to the downside. So let's say you would see that 20 of your losses in 1 year were due because the gap that was created was higher, like bigger than, you know, 300 handles. So you know you shouldn't be playing that. So this is really the reason why, you know, you could find true edge in using those parameters, which is regular trading hour gaps and you know, IFVGs, especially RTH gap. All right. Also, another concept which is used right here is the 930. 930 is opening. If the 930 is opening, it should be a fake out. Okay. And if it's a fake out, then it's exactly what we're playing here off of. The 930 opens, goes down first, influx of liquidity, then you find those sellers being squeezed here out of the fake breakout. Boom, goes back, closes back inside the range, inverses, then you have played back to the upside. Same thing. Or even if you are, let's say, you know, what is it called? A breakout. You know, the people that are looking at the first 15-minute candle, opening range breakout. Let's say the first 15 right here, it was a down close candle. Then what happened was that if you start seeing a price breaking out of that range, all of those people are going to try to short, break, and retest. But right here, what happened was that, let's say this is the first 15, we swept the first 15 minutes low, then we started to push price to the upside, which is going to attract a lot of buyers and squeeze a lot of sellers, which is exactly what happened. So many, you know, edge or strategies are kind of the same thing if you truly take time to look at them deeply. Do I always take those kind of trades? No. You know, I have multiple strategies, I have multiple frameworks, but is this something you can find edge on? I'm pretty damn sure, yeah. So yeah, that was the first trade you could have got just using IFVGs and the simple framework. Then let's say on the other model that we have, so right there you would go immediately on ETH chart, and you would go to the 15-minute chart and try to find any sort of potential opportunities off of fair value gaps. Right, fair value gaps, liquidity right here, bearish fair value gap, there's sellers, above highs, there's sellers that are going to be ready to squeeze those buyers. And then if you scale down right here, there was no possible trades. I already did the journaling here, but right here, the same thing. You would go to the 1, 2, 3 and try to find if there's any gaps here that are getting inversed. Right here, the range is super wide, so you don't want to engage in that. And there's only there's not any time frame that has only one gap, so you would wait here. The question is in regards both 2022 and IFVG strat. And one more thing to ask in a trade: whenever price goes to an internal high and a trade not reached a complete 1R, should we make trade a BE? Because depending on how you're backtesting, really, if it's all depending on your backtesting parameters. If when you backtested, let's say 3 years of data, did you put your stop loss to break even? If yes, then you cannot start, you have to act the same way in the live market. It's all depending on your data. If the data shows you that putting your stop loss to break even doesn't really mean anything, then you keep doing the same thing that you're doing. But if it does, if it starts reversing and it's a point where you should go break even based on your data, then you should adapt. That's really it. So I'm not here to tell you whether it's a good idea or not. It's all depending on, because I don't know. Clearly, I don't know. If I tell you that, it's because I don't know if putting your stop loss to break even is more profitable than not putting your stop loss to break even. How would you know that if you didn't do all the work in backtesting? Know what I mean? So yeah, if that makes sense. Does that make sense? So right here, this is where I would look for a potential long opportunity. We swept the lows here back into that 15-minute gap. Right here, you would go to the 1, 2, 3 minute chart. So right here, potential good trade. Keep rejecting the lows, swept the low here, then the sellers are located right there. If we're truly bearish, we should hold this to create new lows. If we're bullish and buyers are located inside this 15-minute gap, we will disrespect the first fair value gap here. All right, we're at a discount. We're overextended to the downside right here. So boom, this is where you can take a long scalp. Okay, and right here, stop loss right below this low, and with a 1-to-1. So boom, get filled on the pullback to the gap, and then in a few minutes you would hit your target again. Just using IFVGs, pure, telling yourself, okay, in fair value gaps there's buyers and sellers. Bullish fair value gaps, more buyers than sellers, more aggressive buyers, which is what drives the market. Also using liquidity, below lows, buyers are going to be interested to buy price. Above highs, sellers are going to be ready to sell the shares there. All right, so that's the second trade. Not the second. What am I talking about? The third trade right here. Third trade you could have got. And if you ask, let's say, the biggest, let's say the bigger the gap, the gap, the more you can trust it. All right, that's one thing super important. Is if the gap is big and it has a clear swing high, swing low, I'll trust it a little bit more than a super small gap with bad structure. Right here was perfect structure again. Perfect sweep, can't close a singular handle inside of the gap. So I know the buyers are right here. They're applying pressure. Let's say if you trade ICT. you would be against me talking about buyers and sellers, but it's the best way to explain stuff. It's the best way to explain stuff by using buyers and sellers. So then on Wednesday, let's see what it does here. So again on the ETH chart. So right here, at market open, we went to sweep sell side into that 15-minute gap. So right here, the thing you would do is go to regular trading hours and see if there's any RTH gaps. Right here, there was one, but immediately got filled at the open. So then you would go to ETH and then see if there's any potential IFVGs there that you can take. And in this case, there was no singular fair value gap from swing high to swing low, so you would pass on that. Then go here. There is your fair value gap right there, a discount of the previous range. Also this order block right there on the higher time frame. This is your fair value gap at discount. So then you scale down to a 1-minute chart. Let's see what price is gonna do when we're gonna hit this fair value gap here. Hey bro, do you know when we can trade? When is market open? At 6 p.m. so in 30 minutes. Oh, we'll be here to watch it. I want to see what's gonna happen. All right, so right here you see we tap this 15-minute gap again perfectly. So as soon as we tap it, we cannot close again a singular handle inside of it, and that tells me a lot. If we cannot close a singular handle inside of it, that tells me that the buyers are really aggressive. So then what is my next step? Wait to see if we entered aggressively inside this 15-minute zone. If we entered aggressively inside this 15-minute zone, then I'm gonna wait for those sellers to get squeezed. Like I said in the last call, I said that fair value gaps are IFVGs, let's say inversion fair value gaps, are better than fair value gaps, because fair value gaps are if you enter off of them, you're basically praying that the gap will hold. When waiting for an inverse, you're waiting for the, let's say in this case, the sellers to get squeezed. So you know the fair value gap didn't work, so you have, let's say, double confirmation. There is a gap that got created, bearish fair value gap, so you know where the sellers are. So instead of trying to sell right here and predict that this fair value gap will hold just because sellers are there, you will wait for those sellers to get squeezed out of that range on that 1 minute right here, boom. And that is a good scalp. But let's say those scalp right here, like that I'm showing you, they're just like purely a intraday volatility scalp model. Like you don't need really a daily bias, which is something that a lot of people are against. But in such a volatile market like NQ, you could make money in both sides, like going long, going short on the 1 minute chart. So right here again, using the same exact framework, 15-minute gaps located where my buyers were in the market, couldn't close below inside of this gap, then inversed the area where sellers were located. Okay, so again, like you could tell me anything, but the same trade, I'm taking the same trades here, as you guys see, the same exact trades. So yeah, so that was the trade you could have called on Wednesday. So that's what is it? It's the 4th. So that's the 4th trade, and then you'll see on yeah, we didn't have any trading day on, you know, on what is it? Thursday. We didn't have any trading day on Thursday. So then, right, like if you want like the big context behind, everyone just likes yapping about, you know, all the context behind, but let's take here. All right, let's say I'm gonna go here and indicators, and then I go ICT kill zones, boom, and I go here. Let's say I go on the 15, And when I open, all right, what happened? Asia created a range. London swept the low of Asian, and we started to push down again. Okay, so right here we're in a situation where London didn't sweep Asian's high, so we let basically a lot of buy side on London, a lot of buy side on Asian, which means that if we find the sellers here not being aggressive in pushing price down, this could be a good potential reversal, because you would have liquidity of Asian and London being untapped. All right, what happens here is that if you look at the chart, you created a range during Asian, a range during London, and then you started to dump during pre-market. What does that mean? It means that from yesterday's close, we closed, let's say right here, we closed right here close to Asian, and then we're opening lower. If we're opening lower, what does that mean? It means that we're at a discount. If we're at a discount, it means that you have good potential longs. Okay, the sellers are going to try to push price down aggressively, but if you see them getting squeezed, this is a good opportunity to see some upside. This is how you get your bias, right? You can get your bias from anything. It doesn't need to be complicated. But right here, when you see this, longs look good because you're at a discount. Keep pushing price down towards higher time frame for value gaps. So right here, let's say if I go on the ETH chart, we keep selling off and we're at a discount from yesterday's close. So right here, let's say when the market opens, what I do is I just go on the RTH. And then if you go on the RTH, so I get rid of that, and the market just opened. Why does it do that? Wait, what price action did it show me? What was that lag? Wait. That shit was a lag, 2 seconds. I need to see that in real time. Okay, it was showing the price action from okay. Yeah, that's the same exact thing that happened right here, but that was I was looking at the day, but right here this was a bank holiday. So here the same exact thing. Look at what happened. You could have called longs to the upside, which is how you get your bias. Okay, right here, this is where you want to find exhaustion. Liquidity here has been left during Asian and London, not swept, so you're trying to play a reversal. Same thing that happened exactly right here. So but just on the sell side. So right here, Asian formed a range, London formed a range. So those sell side liquidity pools are still intact. All right, so this is a good area to look for possible shorts. So what also happened here is the fact that if we closed here, it means that if we open, there is a gap. There is orders here waiting to get filled from the overnight session. So if you find a squeeze here at the top, you can take a short back towards the gap. So right here, this is exactly what I'm going to do. Go to the RTH chart, and then right here, if I go on the 1 minute chart, Judah swing, 930 influx of liquidity, should be a fake out. Perfect. I have that concept right. Good. Then what do we sweep? We're going to sweep possibly previous daily high here. Say on the 1 hour chart. This is previous daily high. So boom, we went to sweep liquidity right here, which was previous daily high. So right now I'm completely bearish, but I also know that after sweeping previous daily high, I also have my gap here intact. I want to short towards that gap. And right here, what am I going to wait for? An inverse. So right here, this is a bullish for value gap. Buyers on the lower time frame. If we're truly bullish, we should respect this gap to create new highs. If we're bearish, we will disrespect it, squeeze the fuck out of them, and we'll have a short back towards the gap. Okay, so what you can do here in this case is boom, you wait for price to inverse this gap. All right, any type of confirmations. Okay, so right here you created a gap above it, okay, which is again a gap that you can use to take your short from. So right now you would not use this gap here, you would use the gap above. So swept highs after previous daily high sweep, still not inverse this gap. You see here, wicks do the damage, body tells the story. So right here you held. So buyers try to push price up here inside this gap. They try to held their weight. But then let's see what it does here. Pushes up, then boom, big displacement down. Inverse this fair value gap right here, which is our confirmation. Buyers are getting squeezed. Plus, after this line here is the previous daily high. We saw previous daily high and created a market structure shift here. So changing the state of delivery, how you want to call it. Then you go short, stop loss above the high, and you just try to target this RTH gap. That's pretty much what happens. 9:30 opens, shoots up in the opposite direction. This should be a fake out. All right, sweep previous daily high. We have Asian, London lows still intact. You have your bias from all of those concepts. So short here, stop loss right above this high, take profit right there. So let's see what it does. Boom, boom, boom. All right, one handle away from hitting take profit. And right here you hit your take profit, 1.65. Of course, yo, Amos, can I put my stop loss right here so I can have my 1 to 2, just I'm a 1 to 2 trader, do whatever you want. But I think, just holding the same framework every day is what will work for you, right? How would you mentor someone that understands everything you're saying since the start on stream but still stuck? I think the thing is like I keep saying in my Discord, is the fact that a lot of people, either you are taking trades that are not your edge. A lot of people do this, is they take trades that just looks good. If a trade looks good for a lot of people, let's say there's a nice sell side sweep, SMTs at the low, and then market structure shift, they will take it. That's, let's say, a setup that they used to trade 5 months ago, but doesn't, they did not make any profits off of it. But then they will see it again and they will try to stab it. And the thing is with that is that this will cause you to, take unnecessary losses, which will always bring you back for no reason. You will feel like you're break even when the strategy that you're trading right now is in a win streak. All those small losses taken here and there for no reason is the reason why most people are just stuck. I would say some people just don't have a problem, with taking 3 trades a week. You guys want to take too many trades in a week for some reason, just feel like you are a real trader, when in fact, this doesn't have to do, the frequency of trades doesn't have to do with being profitable at all. It's the opposite, So I would say, focus on one strategy. It's either, let's say you want to play the gap fill or you want to play IFVGs. Just make sure, let's say, try to take 15 trades without ever disrespecting your rules. Don't have any expectations over what the strategy will yield you as a return, and you just keep trading. A lot of people have those expectations. They buy an account and they say to me, yo, I'm here to make money trading, but you never know when you're gonna make money or when you're gonna be break even or in a loss streak. You just have to keep trading. This is it. You're getting paid because you're following a system that you backtested in the past and that has proven to you that it works. That's my vision. Some people don't have the same vision. They trade discretionarily, so their vision is, I'm getting paid off of my my decisions, which in my opinion could be good, but I'm just not that type of guy. I'm not that guy. I cannot make money when I'm trading with discretion for some reason. All right, so let's see the other trade you could have caught. on the day, which is right here. You see there's a lot of sell side built up again, which is the bias from the day. You know, you could have shorted all the way back towards that low, but like I said, find your sweet spot, find it 1-to-1, 1-to-2s, what is better for you, and trade that. So right here we have sell side, we have a 15-minute gap, boom, sweep sell side. You see how aggressive that move was? Right here, boom, 1, 2, 3, 4, 5 straight down candles. All right, from the open, what do we need? A healthy pullback. We formed a gap here, we formed a gap up there. When we form gaps, usually if we sweep sell side and we find any confirmation to the upside, we will fill those gaps that are created on the higher time frame. All right, so it's either you wait for price to tap the gap, then you try to find a reaction to the upside, or you basically wait for the same exact confirmation, but you try to aim for an unfilled gap. All right, so right here, this you would wait for price to hit this 15-minute fair value gap right here, then same confirmation. We tap that 15-minute gap, we entered inside of it aggressively by creating a 2-minute bearish fair value gap. What does that mean? Sellers are right here. So basically what the strategy is about is finding blood. Where blood is in the market, when blood is in the market, there is most likely a good trade. So right here, gap equals this bullish gap, M15, bullish FVG means bullish, you have a bullish bias on the higher time frame. Bearish IFVG here on the M2 means you have a bearish bias on the lower time frame. All right, so right now, if you are truly bearish right here, you want to trade with the higher time frame. This zone right here, this portion of price, buyers, when we tap the zone in the past, buyers were the one being aggressive. We formed the 15-minute gap. So now if we entered inside the zone aggressively, then you ask yourself, all right, the sellers are looking at right here. I am not going to try to short that. I know we're overextended to the downside. We just swept sell side. This is an area where buyers will be interested in price. We're discounted right now. I will want to take a long here. So right now you see this box, which is a fair value gap. If we're truly bearish, we should respect this zone to create new lows. If we're bullish, and we will play the scalp model to the upside, we'll disrespect this 2-minute gap right here, okay? And as you guys can see, there is only one leg from swing high to swing low with one fair value gap, which tells me that I can trust this time frame being the area where sellers are in the market. Boom, we disrespect that area again with one candle. This is like the best possible confirmation. If after sweeping the low, you have 1, 2, 3, and the fourth candle disrespects it, this is an A plus right here. So you would go long, boom, stop loss right below this low, and then you could go for a 1-to-1, right? If you hate 1-to-1s, again, like just go on the 15-minute chart and find your fair value gaps, find other targets, trim, you know, and let it ride. You know, that's the only thing. Do whatever you want, but just keep the same framework of analyzing price and entering the same exact way. Right here, so boom, so you would enter on the 2-minute, sorry, and then let's see what it does. And here, boom, you would take out your profits. Let's see what it would do if we would have held here. It's a long time to hold, but you see, of course, you could have had that 1 to 2, 1 to 2.5, of course, but keeping it pretty tight with that 1-to-1 will make you, in my opinion, not bleed as much in bad market conditions. All right, so that's again a really good trade you could have caught right here on the long side, which is like what, 1, 2, 3, 4, 5. It's the 6th trade right here I showed. And then the 7th trade, which is what I took on stream on YouTube, is that long here. So what happened was that we held, and then boom, see what happened. Created a 50-minute bearish fair value gap right here. So if we create a gap here, I know there's a lot of sellers with orders ready here to get filled. Okay, they have passive orders ready. Okay? They were being aggressive on this 15-minute candle, and price didn't trade from the first candle's down wick to the third candle's up wick. This price right here is, you know, dominated by sellers. All right, when I know this, I know there's a lot of you know, limit orders right there. There's liquidity sitting inside this gap. So what am I trying to do? I see that we're rejecting sell side. We're tapping a zone where I know buyers are located at. I will try to take longs towards the unfilled M15. So this is what I did. So right here, I didn't use an IFVG. I used a 2022 model, but it was because of the framework. You know, I swept the AM low, AM lows right here perfectly. Closed back inside the range, bullish, 15-minute gap, and then we had an unfilled gap to the upside. So what are the odds that structure right here is not going to hold? Pretty slim. It's a good try. It's a good play over time. So this is where I went long. Had a tighter stop here. I was at a 1-to-1, or I think I entered a little bit above that, but I was like this, and in a few minutes I hit the target right there, boom. But of course, in this case, price could have, like, it went to the upside pretty aggressively right after. You know, it went and then kept driving to the upside, which is a good thing. But is that really something that is repeatable over the long run? Will you see those kind of moves always happen? No. So in prop firms, if you're trading prop firms, you want, in my opinion, you would want a lower RR, just so your win rate is higher and your risk of ruin is lower, which means that the amount of trades you lose in a row, that you could lose in a row depending on your system, is lower, just because you demand less from the market in terms of handles. So again, another trade that I caught, so at least 7 trades based on the same framework. First framework being, you know, M15 gaps. M15 fair value gaps tells you where the buyers are in the market, sellers are in the market, and you try to play a potential reversal on the lower time frames for a small move, you know, a 1-to-1, you know, 1.5 to 1 if you want, but you know, using 15-minute fair value gaps as your intraday volatility scalp model bias tool, basically. And 2, you have the RTH gap fill, you know, which is another framework used. You're using the same thing, IFVGs, as your entry model. And basically what the RTH gap tells you, if you're at a discount, at a premium, if, you know, the open was a Judas swing, so if the open push in a direction which is most likely going to create a fake out, was just an influx of liquidity to fill bigger orders above you or below you, to then drive the market back where it wanted to go, basically. And then 3, it would be what is it? But yeah, just to target unfilled gaps, unfilled M15 fair value gaps. That would be it. So you target M15 fair value gaps by using the same framework. You sweep sell side, you're bullish. You tap, you're distributing from a bullish fair value gap. You are bullish. You know, you create 1, 2, 3 minute bullish PD arrays on the, you know, on the lower time frames. You're bullish again. You disrespect lower time frame fair value gaps. You're bullish again. There's so many confirmations that adds up, so you can take the step back towards an unfilled gap because you know there's orders sitting there. So right here, like, in my opinion, you don't need to overcomplicate stuff. Fair value gaps, liquidity, understanding where buyers and sellers are just by using gaps and highs and lows. With this volatile market, you can find good trades. That's the same thing I used here on this exact trade, but I used the market structure shift. So right here, the breaker. What is a breaker? It is when price creates, let's say, a high, low, then creates lower high, lower low. So right here we created a bearish order block. If we're truly bearish, we should respect the zone to create a new low. But right here what happened, disrespected it, which creates a zone where there will be potential cover in the market. So you would want to go long here off the pullback to the breaker, which is what I did right there. Is there any question regarding like the trades using the same framework every single day? Like if you ask me, oh, Amase, is that all you trade? No. You know, I trade stuff that I just don't talk about on YouTube, you know, with, let's say, that I don't teach here, that are super valuable still. But with that, in my opinion, liquidity, fair value gaps are the best concepts. It's like in boxing, like I keep saying, you don't need to be a master of everything. If you're a master of the jab, cross, you could be the best boxer in the world, possibly. If you mastered the jab already, which is the first punch you learn in boxing, you'll be better than 99.9% of people. You don't need to be, shifty and, have the best everything. You need to be good at, 1-2 things, or great at them, to be better than 99.9% of people. How would you go about funding adding many prop firms? I think I have a point of view on that, and I think too many people are trying to go too fast. They're trying to go too fast. It's like, why would you need more than 5 accounts? Starting with 5 accounts. Like, if you're not consistently pulling out money from the market with 5 accounts, don't put yourself into debt, or don't start to switch firms and stuff, and try to put more accounts into a copy trader if you're not consistently profitable with 1-2 accounts. Even I would say, like 5 accounts, if you just take, let's say with Tradeify, you can have 5 accounts. Okay, let's say you have 5 accounts that are 50K straight to funded accounts. Okay, that is 10K USD in payout. All right, if you're from a, let's say, third world country, or not even, if let's say you live in US, you get those, let's say you have a regular job, which is what most people have. If you have a regular job, plus you get 4 of them in a year, you're making pretty decent money, I would say. If you get 4 payouts and you're taking things slow, which you guys this is what you guys should do, taking things slow, not over leveraging. Too many people are over leveraging, trying to aim for 1 payout a month. This is not realistic. Not every market conditions will be win streaks, So 5 50K straight to funded accounts, like you're consistently pulling out 10K, let's say every 1 month and a half, 2 months. If you get that, let's say if you get that 6 months in the year, 6 months in the year, that's 60K profits USD, only with 5 accounts. If you start burning money here on evals and there on evals, it will add up. It will add up to a certain point where you would be like, oh shit, I could have bought 5 straight to Sims with that, but you decided to go gamble some evals to have, let's say, 15 accounts with a firm that is possibly not going to pay you out, or you're going to do some weird ass shit when you're going to request the payout. You know, just stick with one firm that is going to pay you out, that has a good CEO, that never did any shady stuff, and that's it. 5 accounts is enough for you to make consistent money. You know, that's my opinion. Too many people are just trying to aim for that 20. You know, the pressure that it puts on you to trade with 20 accounts, knowing that you possibly don't have what it takes to reactivate all those 20 accounts or to repass those evals, is insane. You cannot, if you enter a trade, like I keep saying to the people on my Discord, if you enter a trade and you feel the butterflies, you are over leveraged. Not even necessarily in terms of contracts, but in terms of accounts that you're copy trading, you could be over leveraged to a point where you're not going to take the good decisions. Can this strategy still work for it? A 15-minute gap, get disrespected and inverse still? No, I don't use them this way. You know, it gets try to play both sides every time. Waiting for a 15-minute rally gap to get inverse. I see basically on the higher time frame, basically the order blocks are so strong. So even if you disrespect the fair value gap on the higher time frame, the order block holds so much. You know, the bottom, let's say the initial order block, let's say here, it's on the 15, all right, exactly like this scenario. Like, order blocks are so strong. Let's say here, even if you disrespected this, let's say all the gaps here inside this range, boom, this was the last gap. I wouldn't try to go short, let's say if we pull back and then hold. Why? Because I know the order blocks are so goddamn strong on the higher time frame. Like, I don't just frame all my trades based off of that, you know? Is there any questions on that was a good question, by the way, on prop firms. I think too many people are uneducated with that concept, prop firms, and always people are always trying to do more for some reason. Let's say you blow an account. I see that happening so much. Let's say you blow an account, and then what will happen most of the time, and I used to be the same guy, I would blame the fact that I didn't get the payout even if I was on a win streak just because of the rules. I was like, oh my god, they require me to get this amount of money, and then like, it's not possible, man. I was like 2 trades away, and my strategy didn't work, and then if I was with this firm, I would have gotten the payout. But realistically, even if you go with the other firm, if you got the payout, you would have blown the account as soon as you would have got the payout, and then you would have been back in that spiral again of passing eval and do this and that. If you get, let's say on straight to sims, why do I like straight to sims? Let's say 150k, they're the best. Why? Because yes, the first payout is super hard to get. Okay, it would be hard to get. It would take you at least, good trading for around 2 months, all right, without over leveraging and stuff. And yes, you would get the first payout, which is you would request 3k, but your profit target is 9k. But what will that do is that it secures you such a big buffer that the next 3 payouts are inevitable. Like, you will get them. You have 6k drawdown left, and you have 3k profit target after the first payout. Yes, the first one was harder. Okay, you're possibly going to have to deal with psychology and stuff, but once you get the first payout, then you're most likely going to go live if you don't fuck up. Same thing for a 50k. It's a little bit harder though, but on a 50k, you need to make 3k to request 2. Okay, 3k profit target, and then your payout, you get 2k payout. but that still gives you a 1K drawdown. But what you can do is request 1.5 and have 1.5, then make another 2K or 2.5 and request another payout. Another 1.5, sorry. If you can request, let's say 1.5 and then make another 1.5, stuff will get easier for you. That's a good question. Good questions right there. But yeah, Tradeify, you don't need more. Like 99.9% of people don't need more than that. Depending if you're a sim farmer, because that's what we see usually on Twitter. It's the sim farmers. If you're someone who cannot, who like doesn't have a lot of money, don't compare yourself too much, okay? Because a lot of people, let's say, of course they will show big payouts, but the bigger the payout, the bigger the initial investment was, and the more money you had to pay in activation fees, and possibly the more accounts you've blown, and it just gets bigger and bigger, you know. Nobody shows when they lose. You always see the highlights on oh shit, the market just opened. Holy shit, that's a massive no, not that big. I've seen worse. But yeah, ask me other questions. I wanna spit about that a little bit more. But yo, just tell me if my cam is better. I just want to know, because my cam last time I did a live, it was not that quality, you know. So just tell me if I did a good cop or if it's just normal quality. I think it's better. It's definitely has to be better. What am I looking for right now? Looking for to go and eat some dinner, you know. I'm not looking to trade. Do you think I'm looking to trade Asian session? Oh hell no. What you guys should do is touch some grass right now, you know, and wait for New York Open. You know, especially with the war and stuff. Let it cool down a little bit. You know, let it cool down and come back tomorrow. That's it. How long have you been trading? How long did it take you to get consistent payouts from prop firms? You know, I started trading when I was back in 2021. No, what am I talking about? 2022. But I wasn't taking it seriously. So like, let's say the first course that I ever bought was in 2022. Didn't take it seriously for around I looked at the videos but didn't put a trade, and you know, didn't bought the trading view subscription or started backtesting and having a plan, etc. So like, I really started being, let's say, full-time 12 hours a day in early 2023, you know. So it doesn't take a lot of, not necessarily if it doesn't take a lot of time, it does take a lot of time, but I had the chance of being, you know, full-time into it from the start. You know, I was putting in 12 hours a day from the beginning, from back in 2023. So it adds up way like super fast. Like when you start hitting those 12-hour days consistently for a year or two, but most people don't have access to that time. You know, it's the time that makes the difference. If you're like, let's say 35 years old and you have a family, then putting in 12 hours a day is unrealistic. You cannot do that, you know. But when you're 18 and mommy and daddy are putting food on the table, then it's super easy, you know. So I was blessed with that. Uncle Time, I'm gonna stick around till the end. Love your content. I appreciate you, man. I appreciate you. That's love right there. I'm gonna post like the PDF of exactly like all the trades we went back and did today. You know. But yeah. So oh shit, my fault. So yeah, if I have one suggestion, let's say in terms of prop firms, is to stick with one firm that you like the rules. For me, it's Tradeify because I want a firm that will 100% pay me. That's one thing. I want a firm that 100% will pay me. That's first. Second, I want a firm that doesn't require me to multiple days. Let's say if I was willing to trade an eval, doesn't require me necessarily to pass an eval, right? Which is a huge factor. I can just buy a straight to sim funded account and be funded the next day, so which is crazy to think about, but it's real. So you don't even have to pass an eval. So for me, like when I saw that straight to sim was actually a thing, I actually couldn't believe my eyes, because back in the day, nobody was trading. Like let's say even firms like CFD firms, you needed to do 2 evals. Even back in the day, futures firm, you needed to do 2 evals, it was super hard. I just blew my 5 accounts trading this bullshit. What bullshit were you trading? And what trades did you take? Did you note them all in a journal so we can look back at them and see if you tilted or went in 3 cons at a certain point because you didn't get the payout? Will this life be saved? Yes it will. But then yeah, straight to sim funded accounts, and I don't want my profit target to be too high. Again, like these are all the things. Straight to sim, I want a firm that pays me 100%. I don't want to waste my time. I don't want it to cost too much money. I don't want to invest too much in the first place, because if it's too big of an initial investment, why would I try to fund it when I could just put the money in the live account? But that gives you the chance to, let's say the initial investment would be what, let's say $1,000, but you have $4,000 of capital worth of drawdown, let's say. Or if you have $2,500 of initial investment, not 100, what am I talking about? Let's say you're trading 50K straight to sims, then the initial investment is like 380 times 5, which is what? 380 times 10 is 3,800 divided by 2, 1,400. Am I tripping? Yeah, I'm tripping. 14. Yeah, no, it's 1,400. So yeah, it's not like the initial investment is pretty low. Is low compared to what you're getting in drawdown. And then last thing, the profit target. It's all about the profit target to drawdown ratio. My profit target is 3K, but to get out 2K of the account, which is great. Yeah, I was actually tripping. Don't ask me to do math, bro. I've been in front of that chart since fucking 12. But yeah, so 100% getting paid out. You don't even have to pass an eval. Your initial investment is the best you could possibly is far better than on a live account, and your profit target is pretty low compared to other firms. Let's say if you want me to be honest, let's say you're using a firm like Top Step. For you to get paid out 2K, right, on an account, you would need a 4K profit target. You need to put your account up from $0 to $4,000 to get 2K, to get a 2K payout. which is, in my opinion, insane. All right. Then what's the question? How can you tolerate losses in revenge trading? Make sure that when you're trading, you're not trading to feed your family. That's first. When you're trading, you cannot need that money. That's first thing. And second thing, just how to tolerate losses. That is a question where a lot of people are asking me that. But how do you tolerate losses? You need to see it super long term. The best traders or the best entrepreneurs in the world are just people that took something and try to become 1% better every single day. If you try to become 1% better every single day using the same framework, journaling every day, backtesting every day, you have a big folder of 4,000 trades you took in the past, it's inevitable that you will succeed in any endeavors. So just take it as a process, as a journey. Love the journey. And the journey is never ending, It's never ending. There's not a point in trading where you feel like you made it. Because you always have to adapt. Some stuff are not going to go as planned. Bin eats bin. Bin. Du lait. But yeah, that's pretty much it. So view it as a journey, not as a get rich quick. Like too many people just buy, let's say, a 50K account, and if they don't get the payout at the end of the month, or if they didn't change their life with that 50K account, they will not be satisfied. It's like, do you know how hard it is to make 100% of an account? It takes you at least 100%. I'm actually tripping right now. Like, I need to go to sleep. But let's say making 100% of an account, which is what is the payout, it will take you a month, of good risk management. If I'm talking about good risk management, not what you see on Twitter, like guys making 2K a day on a 50K account, that is not good risk management. Whatever, you could have a 1 to 5 RR system, making $1,000, like $2,000 in a day with a 50K account is not realistic, right? Especially if you have low RR, but it will take you a month. So don't expect too much. Stop comparing yourself to people that's on Twitter or that are showing their payouts. You never know how much they actually paid in activation fees and what they're currently dealing with, right? Never ask to have what someone else has, because you don't know how they get there. Yo, what's the bias this Asia? I don't have any bias during Asia. That was just a recap / outlook of the week. Let's just see the outlook of the week, what I think is most likely going to happen. We already hit the draw on the weekly chart. We already hit the draw on the weekly. But let's say here, if I go on the weekly chart, let's say right here, the draw was this low on the weekly chart. So as soon as we opened, we gapped down towards the draw. So basically this low, if we would have opened here on Asian and then start pushing to the upside, let's say on Monday, then if Monday is going to be accumulation, then Tuesday would possibly be the high of week, market structure shift. Then you take shorts on Tuesday, you add on Wednesday, you add on Thursday, and then you take the pullback play on Friday. You go long on Friday. We would short the whole week, but right here already took the draw, so you would need to see what Monday does. That's why you wouldn't, a lot of people that frame their trades based on the higher time frame and the weekly candle, don't trade Mondays, because they need that day to be able to see, okay, what did we do? If we do this on Tuesday, then this should be how the weekly candle would act, because what is a weekly candle? Like, let's say here, this candle. A candle is the same thing. It's just if you're reading a higher time frame candle, then it's fractal. You could possibly understand what is going to happen on Monday, Tuesday, Wednesday. So let's say here we opened. Okay, what usually will happen is that Monday will accumulate, which is the open of the week, and then let's say Tuesday we would sweep Monday's low, create the low of week, and then we would mark a structure shift on the higher time frame. And a lot of people are either trying to enter inside this wick creation when we're starting to get above the open, all right, or either predict that this candle will become bullish or will close bullish after we start seeing bullish signs below lows. Okay, but this is how you want to catch high RR plays, which is not necessarily what you want to do. Let's say here you open, you went lower first, and then you shifted above this opening price, and then the rest of the week you could buy this. These are good buys, and then on Friday this is where you would try to catch a pullback, because you need to create the up wick of the weekly candle, but those are different frameworks. You don't necessarily need it to frame a trade on the Nasdaq. This is gonna be a bloody week, 100%. Make sure you trade micros though. Alright guys, that will be it for this live today. I appreciate you guys so much for showing up and sticking there with the live. I'll be live on Tuesday, 12:30. I'll make an announcement on Twitter, so I thank you guys so much. Last thing I did, so basically what I did in this session was I went back and looked at the trades you could have caught this week using IFVG framework and using the RTH gap fill strategy that I have on my YouTube. There was like 7 trades that you could have caught this week just using this framework. We went over also what I thought was the right thing to do with prop firms and what you should look for a prop firm to have, let's say with Tradeify. And that's pretty much it. So if you guys want to support me, make sure you use my code. Code Amos on Tradeify gives you the highest discount. That would support me. You want to watch oil and gold? Oh my god, yeah. Gold should be pumping the fuck out right now. Gold, yeah. Gold is pumping. But yeah, thank you guys so much, and I see you guys on Tuesday. Much love, guys. Peace out.